For both the commercial real estate market or the CMBS market, as well as the high-grade investment grade market, corporate market, we have seen underperformance in the second quarter. Both underperformed by about 1 to 2% to swaps. So they still overall had positive total returns because of the rally in the Treasury market and their consequent duration. But as a relative investment, they still underperformed for very much those reasons of risk coming off in our marketplace, and these looked at as sectors that contained that risk and sort of reflected the fundamental underlying risks. Both the commercial market and the investment grade market both key off of our underlying economy, both key off of our macro data that's coming out from both GDP, unemployment, and such. So as sort of broad investor macro views shifted from, wow, this is an isolated European problem, to, well, this isolated European problem might be a little bit larger than we thought it was, and certainly could have some spillover to the U.S. economy. And additionally, the U.S. economy numbers started coming out weaker. We saw that fear reflected, and investors start to back away from our marketplaces. Now, interestingly, neither market was a washout. Neither market has completely underperformed.
Just the fact that you have higher spread volatility, it tends to raise spreads versus the risk-free rate, and it's something that we're going to have to deal with for the next 3 to 5 years just because of all the new banking reforms. And
specifically from our perspective in commercial real estate, for sure, we're starting to see the reflection of underlying weakening fundamentals. So we're seeing, in industrial and retail and office space, we are definitely seeing sort of a flattening or a underperformance of underlying fundamentals. So our effective rents are flattening out, our vacancies are starting to flatten out, if not rise, and those things are pressuring the underlying commercial real estate market, which has gone on a pretty decent recovery since 2010, and we've sort of seen that reflected from a performance standpoint from 2010 to 2012. We've seen a very decent and well-performing market, and we've just seen the beginnings of sort of this weakening of the broad macro economy come back through. So the same fears that are impacting the S&P, that are impacting the world in many ways, China and Europe, as well as the United States, fears of slowing economies and contagion of credit markets, we're seeing it on the underlying fundamentals, and you're supposed to ask for more spread, and you're supposed to ask for more return in those markets. So for us, in terms of a question of where our opportunities are to continue to look into these sectors for places that we can protect ourselves from the uncertainties of the future, look for underlying asset classes and sectors that can give us returns, higher than average returns, given what the risk premium looks like, but actually protect us through either the structure or the underlying fundamentals. Something like seasoning can give us more protection against that potential volatility that could come through those fundamental markets. So in many ways, from a security selection bias standpoint, which is really where Putnam focuses, we've been able to use these environments of sort of risk off or widening spreads to really use our security selection skills, go in and be more specific about the types of risk we're taking, and take bets that actually kind of can give us a higher return for per unit risk than what we were seeing previously.
I think we have a very similar situation with RMBS, where obligations or loans that were originated between 2003 and 2005, which are really pre-big 2006-2007 bubble, have a much steeper credit curve than what the market assigned. The subsector of the securitized market will now separate different investors greatly. In 2009 and 2010, you really wanted to have beta. Security selection had a little bit of importance, but beta was the main driver of the returns. In this environment today, when you're not sure if it's going to be a risk-on or risk-off environment, the subsector selection becomes so important, and it can really differentiate negative returns for a year versus another investor having positive returns, yet they're both invested in the same sector. Well, the fund will invest in U.S. real estate market in a way. It's both residential mortgage-backed securities and commercial mortgage-backed securities. What we find with that sector of the fixed income market is that they offer yields in excess of similar risky assets, such as high-grade corporate bonds or even high-yield corporate bonds. Mainly, it will be a large percentage of residential mortgage-backed securities, and on top of that, it'll have exposure to commercial mortgage-backed securities and interest-only securities. The reason why there is a prepayment strategy that's attached to the fund is that, one, it is also a distressed mortgage, and two, or is impacted differently from the housing market. The RMBS sector tends to benefit if U.S. housing goes up, and the interest-only securities tends to be negatively influenced by the housing market going up. But combined together, it is a way for us to reduce the overall exposure of the fund to the U.S. Housing market. Another way to say it, it's to be housing agnostic. But yet, even though it is hedged in that way, it still offers significant risk-adjusted returns versus comparable assets in the U.S. fixed income market.
Even with a fund that is targeting such a specific asset class and a specific investment profile, we still feel like we can get diversification benefits out of combining some of these various sectors and some of the various underlying fundamental and technical bets that are in them. So it gives us an ability to sort of play off some of what the market is giving us in these various sectors, such that we're getting actually improved Sharpe ratios or improved return profiles through diversification, even with such a specific bet.
The RMBS market is a very, very large market. It is now $1 trillion of current face. It was $1.6 trillion at the end of 2007. That is the same size as the high-yield corporate bond market. But because it's a market that tends to be a little bit more complex, it has forced certain investors in the last 3 years to shy away from the sector. And that's why a firm like Putnam is really well placed to be able to take advantage of that discrepancy and really get paid handsomely to have exposure to that complexity. Because once the complexity is broken down, it becomes a very, very simple product, and you get compensated yield-wise to have exposure to it.